After years of booming prosperity, the worst economic downfall in America's history took place. On October 29, 1929, the Wall Street crash, or Black Tuesday, left millions of people with nothing but their names. Poverty rates skyrocketed, and many people were ruined along with the market. 16 million shares were traded on the New York Stock Exchange in a single day. Billions of dollars were lost, and the worldwide Great Depression began. Just prior to the crash, as the Smoot-Hawley Tariff Act was being debated in Congress, the market experienced periods of selling and trading interspersed with periods of rising prices and recovery, which led to overall instability. False expectations of making money off of investments occurred, and people lost everything. Between 1923 and 1929, people were buying huge amounts of stock and seeing up to a 400% increase in investment. But by the crash of the stock market in 1929, they thought it would be time to cash in on their shares. The total shares fell by $40 million in just one day. There were overpriced stocks, illegal manipulation, and insider trading. There really were no groups that supported the stock market crash of 1929. It affected a lot of people negatively, and they lost lots and lots of money.
Stock market crashes occur at least once every decade and differ in the degree of severity. To ensure trust and hope, the United States Congress created the Federal Deposit Insurance Corporation, the FDIC, which protected up to $2,500 in an account in 1934. Today, the FDIC protects up to $250,000 in each depositor's account. The Federal Reserve can control inflation, a major economic measure, by changing interest rates. There are high interest rates to remove money from circulation when inflation is high. Also, there are low interest rates to increase the amount of money in circulation when inflation is low. The Wall Street crash led to the Great Depression. Many Americans lost their jobs and could no longer spend the amounts of money they could before. 12 million people were unemployed. 12,000 people lost jobs every day. 20,000 companies filed bankruptcy. Borrowing money increased during the time because banks were failing and people's credit gradually worsened. Over 1,600 banks became bankrupt. The Wall Street crash psychologically affected the confidence of most Americans. People were afraid of spending their money. Similar to the 2008 real estate market crash, people refused to spend their money because they did not know what the future held. 23,000 people killed themselves in 1 year.